So thanks everybody who's been able to join early and promptly. Appreciate that. We know everyone's busy. Dan, Hector, I think Dan, Hector, did I say Hector the Spanish way? Hector, Hector. Uh, y'all can laugh at me as much as you like. Why don't we get started with intros, and by then hopefully another couple people have joined, and then Dan, you can launch into it. We planned an hour, but I find if we can hit the main points for 12:30, that's nice. We do a Q&A and a wrap up, and typically, we'll definitely end by 1, if not a little before. So I'll go briefly. So this is Andrew Barker of Middle Market Advisory LLC. I'm the organizer of today's webinar. Pardon, I'm speaking really fast, but I'm excited to get started. This is going to be fun and interesting. I'm a certified public accountant. I speak Spanish and Portuguese. I do M&A, fractional CFO work. So this webinar is really interesting to me, as this is something important for my clients in terms of how to best structure financing for different kinds of real estate deals, and in particular take advantage of support from our federal government via the SBA. So glad to be here and glad for you all to join us. Hector, do you want to jump in?
Sure. Again, thank you everyone for joining us today for this Lunch and Learn. It's a pleasure to have you guys here and allowing us to present our Wells Fargo Small Business Lending. My manager, Daniel Adams, will be doing the presentation, but I'm a senior small business development representative for Wells Fargo and basically a mobile commercial banker. I don't work in a branch for my job, or I'm above the branch level and just do bigger loans and some other services that I offer that the bankers in the branches don't offer, but I do partner with my several branches throughout the Metroplex indirectly in areas that I focus where there's a lot of growth and development. That's enough about me. I'll turn it over to Dan.
All right, Hector and Andrew, thank you so much. So Daniel Adams, Hector and I say we're in the North Dallas or North Texas market. See, I've been with Wells Fargo 18 years in a variety of positions, commercial banking, business banking. Really, our hallmark in any of those roles is that we bring the bank to the community. So you won't typically find us in a retail banking branch. The key to what we do, and again, we're going to talk about SBA lending this afternoon, but really this is not meant to be like a self-guided. This is not a do-it-yourself type of thing. I mean, if we're the competitive advantage, or really the personal advantage, is that we work with you one-on-one. So we're going to provide an overview of SBA and maybe Wells Fargo's role in SBA, but mostly it's about establishing a dialogue and really walking beside you, not across the desk from you if you're wanting to talk to us about an opportunity or a need. For us, the key is to earn your trust and confidence and be transparent in how we share things, so that at the end of the day, we're able to, as I say, kind of go from being across the table with you to being alongside you, next to you, looking through your financials, looking through your plans, looking through your goals, and really helping you get to the destination, rather than, again, analogous to maybe a checker or something like that. We're looking to be a consultant. I know that a lot of folks use that term, but truly, one of our biggest frustrations with banking generally is the mystery that kind of gets tied to it. So again, there's a presentation here, but the presentation really is designed to spur a conversation, whether that's during this next hour or whether it's one-on-one with anyone out there. It's really about us being transparent. There's nothing that we do and there's nothing that we do, or the way that we do it, that we want to keep a secret. The more transparent we can be, the better. But thank you for joining us.
Yeah, thank you, Dan. So go ahead, don't let us hold you back. Let's jump right in.
Okay, let's go for it. So we're going to talk about SBA lending. This is not going to be a commercial for Wells Fargo. It's really to be informative and, again, to spur more conversations, more questions. But let's jump in. So what do we do within our group? And again, this is really fast because I purposely do not want this to be a commercial for Wells Fargo. It's designed to help you kind of make decisions. But we do SBA financing on owner-occupied real estate. So owner-occupied means that the buyer of the building or the owner of the building occupies their business, a business that they own, occupies at least 51% of the real estate. We also use that to fund acquisitions, startups. We're actually pretty active still, albeit we're in Texas, which is a economic miracle in and of itself. But startups, anything from healthcare startups to, restaurants, for example, stuff that you wouldn't really banks tend to shy away from. But we do provide financing for startups, buyouts. Two partners, one wants to retire, the other one wants to keep the business going. We'll finance that, and then expansions. And those expansions could be anything from buying another business to opening up a second or third, fourth location. So we do that. And now another area that we're particularly adept at is healthcare financing. So for us, we define healthcare as physicians, dentists, veterinarians, and optometrists. And we do some really interesting things there. I mean, a credit officer would probably tell you we do some pretty aggressive or kind of outside the box financing.
Well, that's good.
Yeah, I'll give you an example of that is, with zero down payment, we'll finance a dental office, right? So maybe let's say you're a dentist and you've always wanted to own your own practice, and family dentistry is still alive and well here in Texas. Well, and in other parts of the country as well, but we will finance you up to maybe $500,000-$600,000 with no equity injection, essentially no cash down payment that you would necessarily need in most cases to really start up your own practice. As a matter of fact, just to give you the 30-second on that, we'll finance a dentist who wants to start up their own practice. We'll then finance a building that maybe that dentist wants to occupy, again, with zero down payment. And we'll talk a little bit more about that here in a moment. And then if that dentist maybe hires an associate and 5 years down the road wants to sell that to the associate, we'll finance that associate's purchase of that practice with zero down. In 10 years, we would potentially finance a startup dental practice and for dental, optometric, veterinarian, any of those would work. But a startup dental practice, we'd finance the purchase of real estate, we'd finance the buyout of that practice by the associate. All three of those events without any down payment. So it's a really, if you're in one of those industries or in one of those specialties, certainly something we'd love to talk to you about. Our group also does lines of credit, anywhere from, well, I say 75,000 on the slide, but $30,000, $40,000 lines of credit, up to about $1 million in a line of credit. General rule or general guideline is about 10% annual sales. So if you look at it and you say you're a business that's doing $1 million a year in annual sales, again, it's with a bunch of other criteria that we're happy to share with you. But maybe in that case, $1 million business typically has a need for about 80 to 120, but let's say call it 10%, $100,000 worth of credit line on a line of credit. A lot of credits are is a revolving line, so again, it's meant to be short term.
Primarily for working capital, I imagine.
Yes, sir. Exactly. Buying inventory, expanding, hiring employees, things of that sort. I will say that, and especially in the context of small business administration, pretty much everything that we talk about, it's not a requirement, but one of the goals, of course, is hiring and growing, right? It includes opportunities for multi-generational wealth, but it also, and I'll tell you specific to the SBA, one of their charges is that the money that the SBA lends, or the money that Wells Fargo lends and is insured by the SBA, will result in more jobs. That's really the calling, or the kind of the mission for the Small Business Administration and us on their behalf. So again, and I'll say one of the things in this final point on this slide is one of the things that we do especially well is, if we're going to lend you that $100,000, we want to take a look holistically, not to sell you more stuff. But the worst thing that you want to do is borrow money and use it just as a kind of a patchwork to disguise inefficiencies in the business. So really, it's doing an analysis along with Andrew, by the way, who does this fantastic way, is, hey, let's say make sure that your business is running efficiently. The last thing you want to do is borrow money and slowly leak that money out over a period of a year or 2 years. And then you wake up and you owe $100,000 on that line, but you didn't really grow the business. So it's really taking a look at the business and making sure that the funds, the capital that's being injected in that business will help that business grow. So again, if you have any questions along the way, by the way, please feel free to let us know here. So let's look at SBA, because that again, and thank you, Andrew, for allowing us to share this with you.
Yeah, thank you.
Group. But let's talk about the Small Business Administration. So when I say Small Business Administration loan, I think a lot of folks look at it and say, ooh, that sounds like I'm going to go to the DMV and get a loan. And it's really tough. I don't enjoy going to DMV to go get my license, and much less to talk to them about financing. That's really not, that's a misnomer. The SBA is a government. Think of the SBA as an insurance entity or an insurance company, right? So the SBA it's actually not even, it's nominally financed by the US government, but it's primarily through user fees that the SBA is financed, if not fully. In the last few years, it's had some government assistance, but that's through the COVID pandemic and things like that sort. But in its really intention is to be a self-funded insurance enterprise or entity, right? So what does that mean? Well, it's kind of the same thing as with your home insurance, right? It doesn't mean that you're going to leave the stove on because you have homeowners insurance, right? It doesn't mean that you're going to, drive the wrong way on the freeway because you have car insurance. It's not meant to be something that's just going to free you up or the bank up to kind of throw caution to the wind. But what it does is provides a safety net both for you in the area of home insurance or auto insurance, but also for the bank in the form of the Small Business Administration guarantees or insurance that they provide. So when we talk about SBA financing, Wells Fargo happens to be a preferred lender, which means that the SBA basically takes all of their regulations, shoves them over to us and says, underwrite to these regulations and you don't even have to come talk to us. So it's a Wells Fargo loan. We will not hide behind if we have any inefficiencies, that's on us. But so we're not going to say, hey, it's government type of thing. No, there are a lot of requirements and regulations, because on the positive side, what the SBA's insurance does, it allows a bank to make I would argue maybe higher risk type of decisions, right? Because there's a guarantee on it, right? And it's not the full loan. So we're not, it's not, again, it's similar to auto insurance. You typically have a deductible. Well, we kind of have a deductible when we're providing a loan that's guaranteed or insured by the Small Business Administration. But it does mean that we can take a little bit more risk. And what does that mean? Well, it means that I tell you, historically, banking or traditional banking, conventional bank lending, it looks and says, we kind of half joke and say, hey, conventional lending looks and says, I'm driving on the road and I'm looking in the rearview mirror. Whatever the rearview mirror showed me for the last 3 miles, that's pretty much what I can expect for the next 3 miles. In other words, it's retrospective. It's based on historicals. So a business, you would look maybe back 2 or 3 years at a business's cash flow and make a decision whether there's a reasonable expectation that cash flow is going to continue into the future. SBA has some of those same attributes, but more than that, what the SBA does, and specific to things like startup financing for a new business where there are no historical numbers, it allows us to make a decision based on projections, right? So that's the biggest difference on a lot of the SBA financing is if you're in a business or you have a need that really is going to be based on projections, on future expectations rather than historical trends, the SBA is a great option. In fact, in many cases, it's the only option from a debt standpoint, right? So who else finances based on or provides capital based on projections? Things like private equity companies, equity injections, friends and family, right? So you go to somebody, you go to your uncle, your rich uncle, and say, I've got this business idea. The uncle may lend you that money. More than likely, though, what the uncle or somebody else like that uncle is going to do is say, hey, I like what you're doing. I like your projections. I like your business plan. I'm going to invest, but I want a piece of the ownership, right? If it grows, I'm going to benefit from that. Debt, unlike equity is probably the most forgiving, right? So if the business plan doesn't pan out, then the equity person doesn't get that upside and they may lose their equity. But debt is almost invariably is the least expensive, right? So if you're starting that business with the idea you're going to grow that, right? And the SBA provides debt financing. Wells Fargo through the SBA provides debt financing for that business. And again, because of that SBA guarantee, it allows us to look at projection based and maybe do things that maybe traditional bank underwriting wouldn't
So
allow.
Dan, in terms of those projections, to try and, 'cause we're already time's flying by, we're having fun. In terms of those projections, are they the standard projections, let's say, that whether it's a a startup, or perhaps, a younger company that's been doing business and successfully in real estate here in Dallas or North Texas for a couple of years, but has a new project? Is there something special about these projections that you would require, or the SBA ultimately requires, or is it more likely the same projections they're using internally, or perhaps sharing with the uncle or other prospective investor adequate? Or is there anything that the listener should know about the projections? Is it likely what they have already works, or is it something special, or perhaps they've never done this before? Is there anything particular you see where, hey, please include XYZ in the projections?
You know what? It's a great question. So it's typically going to be the business plan. Again, there's two business plans, right? Historically, academically, right? There's a business plan that you write and you prepare, and it looks pretty. It's got footnotes. And then there's the business plan that you actually execute on. And that's the business plan that you look at every day and say, how are we following it? But the SBA, to answer your question, there's no secret sauce to it. We're looking for transparency. Now, again, it's a business plan that is also supported by business experience or other experiences, right? So if I want to start a restaurant, I'm going to have to show my business plan could be, great, but I'm going to also have to show, hey, I have some competencies here, right? So, and I'll give the example. The most common example is, for a restaurant in particular, because it's a high risk industry, and we're one of the few banks that'll actually lend into or to a startup restaurant. But you're going to have to show that you have 5 years of experience running a restaurant, understanding a restaurant, understanding how shrinkage works, how ham goes out the back door somehow, but also showing some business acumen. And I'd use the example of, if it's a police officer who's retiring and wants to start an Italian restaurant in downtown Dallas, that's probably not a good fit, right? You can have a great business plan, but you also have to show that, hey, I've got some background. On the other hand, someone who's been running even, like, say, a chain like an Olive Garden for the last 7 years, they've been a general manager, they've been they've done that, then that would be a completely different thing, and that business plan therefore would have more weight.
And and these are very, certainly very appropriate examples for Dallas. I mean, restaurants in, so DFW is a restaurant powerhouse, as we all know and enjoy. But how would this relate to your earlier statement or observation that 51% owner occupied? So let's say that you mentioned dentistry, restaurants. Let's say there's a consulting firm, which can be almost anything, right? Medical or non-medical consulting, maybe it's real estate consulting, and they want to take advantage of that, of the owner occupied requirement loan. And jump in and correct me on the SBA numbers. I'm not an expert on which SBA number applies to what. But in a practical sense, hey, I want to take advantage of this. I'll occupy 51% or 60%. What if anything does Wells Fargo and or the SBA need from me on the other 40%? Like, it's always better if I can have someone in there sooner rather than later. But then, what's the interaction, right? To make that happen as soon as possible, given that typically, if I'm coming to you for a new piece of real estate, I'm not typically going to have someone to say, hey, to rent that additional space to initially.
Got it. Yeah, great question, Andrew. So think of it. I'll give you a couple scenarios, right? Let's say you're let's say you're a consultant. Let's say you're CPA, and you want to have a customer-facing building. So you find this little strip center in Garland, Texas, and you're going to relocate your CPA firm to that strip center. And let's say there's 5 different stores in that strip center, right? There's a nail salon, a dry cleaner, Italian
restaurant.
Yeah, Italian restaurant. Well, so if you look at the whole square footage of that strip center, your CPA office would have to occupy within a year, by the way, but your CPA office would have to occupy 51%. And we literally go out with the appraiser, measure the square footage, determine what percent you're occupying.
All right, so this is important. So if it's, let's presume it's a startup, just keep the case study or example simple. I've got a year to get the other percentage of the space filled. Okay.
Yes, sir.
I still have to make my loan payments, obviously, and do whatever else I need to do. So I'm not in breach of agreement or contract or loan. I'm not in breach of the loan agreement because I have a year to do that. Okay.
Correct, Andrew. Correct. And again, the idea here is the SBA, because it's a government entity, their mission again is to provide financing that will increase jobs at the end of the day. But it just kind of feel like a bad public policy if the SBA was out there essentially financing folks who are speculators, real estate.
Well, yeah, I mean, and it needs to be make that balance between not encouraging over speculation, but also being practical and realistic for small and medium-sized businesses that do want to grow their business. And I think my experience with the SBA has been limited, but I have to say I'm very impressed by how they supported the business community during COVID. So if there's anyone here from the SBA who has a friend there, sincerely, I was very impressed. My respect to the SBA. But yeah, clearly they have a mandate where they're ultimately responsible to support us, but to protect us at the same time. So sometimes it's a little bit of juggling act, but that's what we're here for.
Definitely. And
Okay.
by the way, the other thing that SBA does really well is ground up construction. So in that case, you're building this building, you buy the land, or maybe you're financing the land. But let's say you buy the land and you're going to build a new building. We see a lot of this like in Austin, right, where it's pretty built out, and it's tough to find, let's say, maybe an office building or an industrial building. So let's say somebody just wants to build, or a dentist, for example, they don't want to buy that strip center. They don't want to be a landlord, not yet, but they don't want to be a landlord, but they want to just build a building. And you see, I've got a lot of freestanding buildings here in Texas with dentists. We would finance the ground up construction of that using an SBA loan.
Okay, so tell us, this is another great real world example that I'm imagining at least a couple of our listeners were going to ask about. So what procedurally, like, let's say I'm that dentist, and I come to you. At what point do I come to you? Hey, I'm interested in this land, or I've already found a land and I have for other sources, I already have the money for the down deposit, and what, like, to give us a feel in the real world, like, what's the timing like? Because real estate's a very, even if it's owner occupied, it's always a time driven, time sensitive business, right? Because people want to be in their space. You got to make everything, nothing really starts right from our perspective as business people outside of banking and the SBA, until I start getting someone to pay me for being in the space, right?
Sure, absolutely. So if it's construction, if it's ground up construction, I tell you, most commonly what we see is someone will buy the land, right? Because land loans, there are land banks out there, but most often what we see is somebody has bought the land. Maybe they've owned it for a while, as a matter of fact, and they bought it 5 years ago. Now they're ready to finally build their building on there. We would use the value of that land, by the way, as the equity injection. So again, I don't want to be confusing here, but let's say you have let's say it's $1 million building. And let's say that, that's going to cost to construct $1 million to finish the thing out, parking lot, HVAC, everything in, and you own the land. And let's say the land is worth $150,000. Well, we would use that. So again, not every loan is a little different, but potentially in that
in general, to have an idea.
Yeah. But potentially in that situation, you wouldn't necessarily need maybe any additional down payment, because you're making the down payment, the 10% down payment, using the value of the land.
Fantastic.
So the other thing that we'll do on a construction loan, and it's kind of a funny thing, but just to be again transparent, is we would be we would control the disbursements of those funds, which actually, when you think about it, if you're building a building, let's say you're going to occupy, let's say you're a dentist and you're going to build a building, you want to have a good relationship with your contractor. So again, I don't want to say Wells Fargo wants to be the bad guy, but you do need somebody in there that's actually.
I'd rather have you be the bad cop than me.
Yeah, we'll be the bad cop. We've grown really.
I'm tired of being the bad cop.
Yeah,
but I'll tell you,
it's a real benefit, because it says, hey, we go share and make sure that everything is getting done before we disperse the funds to the contractor. Kind of takes you out of that role. You can have the great, hey, let's look at blueprints and let's go have to create this beautiful building together. Oh, the bank. Oh, well, the bank's going to actually make you prove that you actually completed that step before you get paid. So it's just something else that we do. Now, again, we do it to protect you and to protect the bank because construction, one of the reasons why a lot of banks don't like financing construction is any point during that construction until the business is actually completed, it's probably got negative equity. And in other words, it's probably
Right.
worth less than the cost of if you're a halfway completed building isn't worth half of what it's going to be worth when it's done. So, but again, that's something that we do. We do actually a lot of that, a lot of ground up construction. So let's look at two programs. So the two SBA programs, two primary SBA programs, the 7A program and the 504. Again, people will start talking real fast and they'll say 7A, they'll say it's 504. Different banks do different or kind of specialize in different programs, or there are other entities out there that maybe only do one or the other. I'm going to share with you, we do both. We don't really have a bias. We're agnostic as to which one. They both have different attributes depending on what you're looking to get done. I'm going to just cover real quick on the 7A and the 504, just to give you, and you'll see where they have there's commonality between these two programs. Kind of you'll find that space, and then some of the differences. But the 7A program, that's the program that you use to purchase buildings, but also start up businesses, acquire existing businesses, buying out a partner. So it's not just real estate, right? It's not just CapEx type of expenses. You want to buy a business that has, you want to buy a pool cleaning business, the 7A program is typically the program. The other thing the 7A program does that we do quite a bit of is even if you are leasing a building, not buying it, we'll actually finance those leasehold improvements, right? So let's say you want to put that Italian restaurant in a building, and let's say the landlord says, hey, I've had 3 Italian restaurants fail here before. I'm not going to advance the money to build this thing out and put all this nice, the red and white checkered tablecloths and all that stuff in here. We'll finance those. But a couple attributes about the 7A program. One is up to a 25-year fixed rate loan for commercial real estate, 10 years for the business acquisition or the startup. So what we call long-term financing, right? 25 years, kind of looks a lot like what most people think of when they think of real estate financing, which is their own home mortgage. Well, this program looks a lot like that, right? It's one loan, it's fixed rate, your payment will never change. You can go variable rate, but typically you want to talk to your banker and really explore both options. But again, it's kind of the only loan that you'd ever need for that building. And when we talk about amortization or a 25-year amortization, that means it pays off to zero at the end of those 25 years. So you have the same payment all 25 years. And again, at the end of it, it is paid off. There's no balloon payment. The loan can be up to $5 million. Again, we talked already about the 51% occupied by the business owner. I do want to make a distinction because a lot of folks will see that and say, well, you know what, I want to own my building as an LLC, but I have this business. I have this warehouse business that I want to put in there. Just so you know, it's unity of ownership, right? So if you own the LLC, or you and your spouse own the LLC, and you and your spouse are going to also own the building, that would be the same ownership, right? So it doesn't have to be the identical same legal entity. The warehouse business or the dentist's office doesn't have to own that building.
That's great because that's counterintuitive. I mean, speaking for myself, I'm sure I'm not the only one. That's counterintuitive. Typically, these kind of things tend to be very focused on to the other way around, right? The legal entity. So that's actually really good news. Because I know there's a lot of people, phenomenal entrepreneurs here in DFW and Texas who do wear multiple hats. They've had a business they're running 10 years, and now they're starting another business. And then, as you mentioned, the wife or husband also has a business. So fantastic example. Thank you.
Yes, sir. Yeah, every week or every 2 weeks at least, we get somebody who says, oh, I can't get the SBA loan for my business or my building because I want to put it in my LLC and that's a separate company. It's like, no, we kind of see beyond that. So that'll work. Interest rate, it can be fixed or variable. Generally, you'd want it fixed. It's got that's a nice attribute about it. And again, Wells Fargo, not the ad for Wells Fargo, just telling you the fact, we portfolio all of our SBA loans. So we keep them all. And I'll tell you what that means is that if,
I think we lost you. Hey, Dan, we can't hear you.
I don't know how that happened. Okay, no worries. I'm sorry about that.
Yeah, I think I just had a glitch with Zoom or the
Okay.
bandwidth. Pardon everybody. But you could just repeat that, Dan? Thank you.
Yes, sir. So, the rate, it can be fixed or variable. Again, what we're seeing right now, variable oftentimes is tied to prime. Prime's obviously shot up quite a bit here in the last year. So, but I would say, for example, on commercial real estate, fixed, it's 6 or 7%, not 11, 12%. Variable can be up to 12%. I'm seeing like out there right now. Generally, I would say you don't want that because, one of the reasons to own your building is the predictability of your payments. It allows you to plan a little better, right? You get a SBA 7A loan with a 25-year amortization, and it means that you don't have to worry about, well, what's my payment going to be next year? You can make projections out if it's fixed. Any kind of business except for adult, anything with marijuana, the stuff that we don't really see as commonly here in Texas, thank God on that, but transportation, distribution, restaurants, service businesses, any for-profit business. Again, SBA rule, US SBA rule, it must be a for-profit business. So a church, a nonprofit, that typically, those would not be eligible for SBA financing, but any for-profit business. And again, the down payments range from 10% down for real estate, 0% if you're healthcare, if you're one of the dentist, doctor, optometrist or veterinarian, up to about 30%. And it's sliding scale based on the nature of the business, but for a startup, obviously a little higher risk. And again, except for healthcare, typically that's going to require about a 30% down payment. And nothing, again, as I mentioned earlier, no balloon payments and no covenants. So what are covenants? Covenants are essentially requirements that banks put on loans for you to show that it's your ability to continue to make that payment. So again, I'll draw an analogy to a home mortgage, right? You go get a home mortgage for $400,000 and you make your payment every month. Bank never asks you for anything, right? You lose your job, whatever happens, as long as you make that payment, the bank's not going to call you up and say, hey, show me evidence that you're able to make this payment. Commercial lending is a little bit different in that in many cases, the bank's going to still require you to send your tax returns every quarter or every year to show that, based on that the criteria that they use when they underwrote it, that nothing has significantly changed. And, again, there can be circumstances where maybe at that point you may go into a credit workout group simply because your business is deteriorated, even though you're still making the payment. Nice thing about the SBA and the 7A program is we don't ask for that. We kind of just make your payment. You do your thing. We're typically not going to ask you for any other financing or any other financials during the life of that loan. Let's contrast that with the SBA 504 program. So it also provides longer term financing, again, up to 25 years. The unique thing about the 504, and this is probably the biggest difference between the 504 and the 7A. And again, you don't really need to know the difference. It's really having an open discussion with a qualified banker to find out what's the best fit for you. But because the SBA by statute can only insure up to $5 million worth of debt. Well, the 504 program divides up for example, a building loan into a 50% conventional loan from the bank and 40% loan from a qualified or a certified development company, so a CDC. So the CDC portion of that loan is the portion that's guaranteed by the bank, by the SBA. So again, with a statutory maximum of $5 million, the 7A program is one loan, and we would apply that up to $5 million limit to the entirety of that loan. Where we can go do larger loans with the 504 is because only that 40% is really applied toward that $5 million cap. So the 50% is typically a conventional bank loan. Allows you to go significantly higher in the loan amount. Again, same requirements, 51% occupied. It can be fixed or it can be fully amortized. I mean, it could be variable or it could be fixed, depending on what risk you want to take on. And again, 51% occupied by the owner. Again, it doesn't have to be the same exact entity that owns the building. An LLC can own the building as long as the business that's occupying 51% of that building is the same ownership as our LLC, then that would be eligible.
Got it.
So again, what SBA is 504 is typically larger loans, and typically it's limited to real estate and larger equipment and construction type of
And
finance.
we've got a question, and thank you, Andy, for the question, because we're hitting 12:40, so getting towards that time anyway. So I'll read Andy's question out. It's here in the meeting chat, everybody. What happens in a situation where you want to build out the land, but it is not owned, it is rather a ground lease?
Okay, great question. So if you're going to
30 years, pardon me, I didn't see the big bottom, Andy. For 30 years, will the bank be okay with this, given the real estate is not there as collateral? This is a good question.
Yeah, so the requirement on that for us, for Wells Fargo, and again, other banks might have other restrictions on it, is typically we will, if it's a ground lease, so you own the building, somebody else owns the land, you renting the land essentially. We'll limit our guidelines call for us to limit the amortization, the term of that loan, to 50% or less of the remaining land lease, right? So let's say it's a 100-year lease, right? And you do see a lot of those on ground leases, right? Because you think about a lot of these ground leases, there's a Costco here in McKinney, Texas, it's a ground lease. So the owner of that building, let's say that building's a $10 million building, they're vulnerable, right? Because they don't own the dirt underneath it, but they do own the improvement. Well, if it's a 100-year ground lease, meaning 100 years left on that lease term, then we would limit ourselves to 50 years, which again, we're going to do a 25-year amortization. The more common what you see is maybe only 30 years left of a ground lease, in which case, instead of being able to do a 25-year term, we would be limited to a 15-year term on that. Essentially, the banking, it's not just Wells Fargo, but the bank is going to limit that to say, hey, you have to have that loan paid off before half of that remaining lease term is.
Yeah, I mean, and that it obviously depends immensely on the kind of business, right? Profitability, net cash flow, but
yeah,
I hope that 15% still allows the business deal to go through. Not 50%, I'm sorry, pardon me to everybody. 15 years in your example, 15 years, I would hope still allows the business to proceed, because it's still a pretty reasonable chunk of time. Of course, particulars always matter.
It is, and most of what we see is like 50 years on those, so it typically doesn't have a huge impact. The thing, to your point, Andrew, is again, if you go from a 25-year term to a 15-year term, your payment is going to go up significantly.
Right.
So express that cash flow analysis a little bit more with a ground lease, but certainly able to do that.
Great question, thank you, and thank you for the detailed answer.
Really good question.
If there's any questions, you go ahead and put them in the chat. Dan, what was the next topic you wanted to hit? I was thinking.
I just did a real quick hit on the 5 C's of credit. I always feel like it's important that we talk about these. You don't have to, you don't have to max out on all 5 of the 5 C's of credit, but capacity. So again, what is your ability? So that we look at cash flow. Again, difference with SBA is we'll use projections, and we'll look at your business plan, and the business plan will have a projection, kind of a pro forma budget. But that's the capacity. So if you think about it, every loan, and it's not just Wells Fargo, I mean, any loan that you're applying for, if you ever, let's say you get declined, and let's say some banker gives you kind of a passive aggressive answer that says, hey, we're going to pass on this loan because they don't want to say that we're not going to approve you, we're going to decline you. But you really want to, I really share this with you, that whenever you're talking to a bank, you should go over these 5 C's of credit, because fundamentally, a credit officer is going to look at these 5. There may be some nuances in a loan. There may be something, again, you're not going to necessarily see that, hey, we will not lend in a business that sells marijuana, which, we're not going to do that in Texas because it's illegal here. But let's say we're in Las Vegas. It doesn't say that here, but embedded in these 5 C's of credit is essentially every criteria that a credit officer would look at. So again, just really quick, capacity looks at your ability to pay that loan, your primary capacity, and also your secondary. So let's say you're doing that startup restaurant, but your spouse has really strong W-2 income, and the spouse is going to guarantee on that loan, then we're going to look at that capacity to repay the loan. Capital is how much of your own cash do you have at risk in that, right? Think back to 2008, 2009 with the mortgage problems. There was a lot of times where folks had zero down payments. They had none of their own capital or none of their own quote skin in the game. Character really, that's the one that actually is the toughest to get your arms around, because character could mean that you're going to wake up on a Tuesday morning and you no longer want to be a dentist, so you're just going to walk away, go down to Cabo San Lucas for a few years and find yourself. But the way we measure that, and one way banks measure that, is your credit history, right? Because that says, hey, because the credit history doesn't really get into details. It doesn't say, hey, I got sick this year and, that year. Now, sometimes when you're explaining something on a credit report, it would get into that. But it says through good or bad, good times, bad times, recession or growth, did you make your payments? Collateral essentially says, what's the plan B, right? If you don't make the payment, what does the bank have in order to satisfy at least a portion of the debt? And the conditions talk about more about the macroeconomic conditions, right? So again, we're heading into a recession. Let's say we were, who knows really right now, right? I mean, this has gone all over the place in the last year, but let's say we were heading into a recession. Let's say we're back to 2008, 2009, and you want to come and you want to finance the building of a hotel. Well, again, a recession could have a significant impact on travel, on hospitality industry generally. So maybe the conditions, although all those other four C's might work for you, but maybe the bank, and it may not be Wells Fargo, it could be any lender, is going to look at this and say, hey, you know what, this is not the time to be building hospitality. Hospitality goes into contracts during a recession. So again, just want to go over those with you, making sure that really, you should have that. If you're applying for a loan, you want to have that conversation with your banker. It's better for you to initiate it. Not enough bankers will initiate it with you because they want to leave a little bit of wiggle room. But this is a good thing for you to have when you go to a bank or to a lender and say, hey, you know what? Here's let me explain to you, because all of these risks have mitigants, right? So all 5 of those 5 C's of credit, there's going to be an explanation that you'll have. It may not be a good enough explanation, but you should be able to talk about these 5 C's of credit with a banker, with a lender, and really address, hey, these are my strengths. You know what? Let me look at my credit report. My character is really good. I've had some ups and downs in business, but I've always made my payments. That's my last slide, folks.
I'm going to unmute everybody. Just give me a second. I know some people may be driving, so if they want to ask a question, give me 1 second to try and do this.
You just sign a waiver if you're going to ask a question while you're driving. I don't want to.
Oh, okay.
No, I'm good.
Good point. Good point. Maybe I should have said while they were in their car.
Yeah, in their car.
I'm clearly not an attorney. I clearly do way too much work using Bluetooth in my car. But point well taken. So instead, I'll say, if anyone else has another question, we've had some great questions. Thank you. You can put them in the Zoom chat. And hey, I know how it is. I've been on so many great webinars, and 15 minutes later, a great question hits me, and then so you can always email us. I'll share Dan and Hector's emails again to the participants, and you can always, if connect whatever reason can't find them, or can always reach out directly to me, Andrew Barker at Middle Market Advisory. I'm happy to be a conduit and just connect people to get do business and get deals done. So I gotta say, for me, this was great to really understand in more detail. Like sometimes I hear these things, I'm like, come on, it sounds almost too good to be true. And then when you hear it, it's actually, hey, it's actually pretty well thought out program. And I bet I bet for many, as you grow your businesses over the decades, you probably end up doing these a couple of times, right? So this was really beneficial. Thank you so much, gentlemen.
It is for us too. It's an honor to be able to present to you guys, and again, we do take it to heart that the transparency, right? Again, that's one of our frustrations. Yeah. Hector, I speak for Hector here. The more you ask, don't feel when you're talking to a bank or a banker, it should not be a pass or fail type of an exam. It's not like you're taking your test up to the teacher and then they grade it, or they're going to do anything like that. It should be a dialogue that you have. There are a lot of options. We talked about SBA, but there are other options, right? We talked about maybe the healthcare financing. That's not an SBA program, it's a Wells Fargo program. but definitely, I also wanted to mention one other thing that just that the SBA, because it is kind of a nominally government funded program, you do have to either be a U.S. citizen or a permanent resident to qualify for SBA financing. Again,
Dan, maybe, and again, we're still open to comments and questions and ideas. I'd almost like to learn more just about strip malls. And I work with a lot with the international community here in Texas and the US. So maybe we could do something in the future for that group of people. Okay, they're opening businesses here, buying homes here, like what options, what should they be looking at, right?
Absolutely.
In order to help them become better, become part of the community here. So they can focus more on their businesses and less on sort of getting these things sorted out. And I'll mention, we're looking at doing an in-person lunch and learn, perhaps in September. Summer, so much going on, both social, family, business level, love travel and so forth. So perhaps in September, start the fall off strong and perhaps do an in-person lunch and learn if there's interest here in DFW and North Dallas region. So stay tuned if you're interested in that and like to meet Dan and Hector, in person, and we're happy to do another webinar to revisit this in more detail or on anything else that might come to mind where Wells Fargo, Dan, Hector, and myself at Middle Market Advisory provide some valuable information. And questions are great. And it's great to learn that these are real world tools that people are actually using and we can take advantage of. Thank you so much again, everybody.
Thank you for that, Andrew. And just a couple of little side things to mention to y'all in the area of business startups. And sometimes this is oftentimes a question, right? It's like, hey, you know what should I do? I want to start up this business. I've got friends and family, or I've got credit card, or I've got I got equity in my home. I'm going to use a HELOC. I would say definitely talk to a business banker. Talk to Hector. And Hector is one of the best at saying, hey, this is really not a good fit for us, but there's other bankers out there, other banks that might be a better fit. Sometimes community banks will have a little different.
Yeah, and Dan, I appreciate your transparency. And I'll say this in my experience here, and I've been here in DFW only 7 years. The camaraderie in the banking community here, and I'm not a banker, guys. I'm a customer of the banks just as many of you are. It really is impressive. They know each other and they know which banks have appetite for which things. As Dan and Hector mentioned, not every bank wants to look at restaurants. Fortunately, Wells Fargo is one of the ones that does. But they sort of know who the good people are in the industry here. It's a small community, like many of the professional communities here in North Texas. So you can take them up on that. And I can tell you, whenever I've had a question, I just reach out to Hector and he's like, hey, I'll get back to you about that tomorrow. And he does. And they're happy to be a resource. And in my experience as well, whether you're a young entrepreneur with your first startup or more experienced real estate investor or professional, don't get me wrong, the local branches and banks are extremely helpful, but they just don't have the global view that the business bankers do, in my experience. So, again, if there's something pops into your head, I just reach out to Dan and Hector and say, hey, what about this? And very quickly, they can point you in the right direction.
Absolutely.
Great insight, Andrew. And again, one of those things, for example, when you're doing a startup, if we're not talking about real estate, but a startup, a lot of times folks will say, hey, I'm going to do this. I'm going to do it the tough way. I'm not going to go see a bank. You don't necessarily, you can definitely see a banker. I would say like our most frustrating situations is when we see a business and that business has been running for a year. Now, remember, we'll go projection based, but once we have trends, we're going to have we'll default to the trends. So talk early to a banker. Again, sometimes the answer is going to be, hey, that's really not a bank type. That's not a debt type of thing. Because remember, banks make a relatively small margin and therefore have a relatively small risk tolerance. Investors, whether it's friends and family or just a private investor, they make a big margin, right? They now own a part of your your growth, and therefore they're willing to take bigger risks. But always talk to a banker early on.
Yeah.
The one thing that we want
I concur, and I'll share this from my experience as chief financial officer, and then I know everyone, we're hitting the hour. Two things, and I listen, I respect those amazing entrepreneurs that say, I'm doing it my way, the old school way, the tough way, whatever they choose. I would say to them, right, but look at your own projections. As you grow like gangbusters, sooner rather than later, you're going to need working capital loan or line of credit, whatever you want to call it, because typically that's when you're doing great. So now, how do you bring on new staff, whether they're employees or not? How do you buy the inventory for that new product line? And that's where the banker can be a great help. Hey, we got a question here. One of our attendees, and thank you for joining us again, is from Detroit, Michigan. Hartford Matthews, right? Let me write your name down. Let's Dan, Hector, could you let him know who to talk to?
Oh, in Detroit, he's looking for help in Detroit.
Yeah.
You talk to Hector. I mean, we cover the entire country. We work with a local relationship manager who would manage your ongoing.
All right, so Hartford, if you want to shoot me an email, and I'll connect you with Hector, and we'll get you contact in Detroit. Haven't been to Detroit in ages, and I'll right now try and connect you to as well on my own proactively, because I should have your email from when you signed up. So yeah, happy to do that. Great question. And then again, we're not trying to limit it to Texas. I just happen to be more focused on North Texas since I've relocated here 7 years ago. Thank you again for the question. The other thing I would offer to these startups, and again, if you're going to cowboy it, more power to you, or cowgirl it.
Cowboy.
Ladies, women here in Texas doing some amazing things. But if you're going to cowboy or cowgirl it, many times, and this is not the way it should be, but many times the banker is acting almost as the controller or accountant for these younger companies. And I'm always like, guys, really, let me help you, because it's not really the bank's job. But the bankers actually know how to read financial statements exceptionally well. So, hey, get some free perspective. I mean, sincerely. So that's my two observations for the entrepreneurs and startups everywhere. I'd say.
And Andrew, I just want to add, yes, because when you look at these 5 C's of credit, the worst thing you want to do is to cowboy. And I love that term. Mainly because I'm a Dallas Cowboys fan, and I think I picture crashing and burning right at the end, right, Andrew? But you know what? Think about these 5 C's of credit, and you're going to cowboy it, and you make your profile worse from the standpoint of those 5 C's of credit. You know what? You go get the home equity loan. You max out all your credit cards. Think about what you're doing to those 5 C's of credit. When a year later you say, "Hey, I've run out of options. Now I'm going to go see the bank." You're a lot less attractive to the bank.
Well, that's a really practical, you're being incredibly practical, because I'll say this to the young, entrepreneurs out there. I mean, keep the credit cards for that, that emergency or surprisingly good news, right? Hey, I've got to move quick, secure some amazing inventory at a fabulous price. Maybe that's save the credit cards for that. I mean, credit cards, that we all know, we use them when we need to, but they're extremely expensive way to finance a business. You're much better off talking to your banker, the ladies and gentlemen, Wells Fargo, and say, "Hey, I need a small line of credit, a small working capital line, something, so I'm not relying on credit cards." And I've got to tell you, they'll work with you.
I've been doing a lot of that, Andrew. Good point out. That's what I've been doing a lot of. I'm still doing a lot of SBA loan lending. But we have been doing I've been doing a lot of lines of credit for a lot of companies, because for that specific reason is I tell them, keep your money in the bank, even though you have it to pay the bills. Use the line instead to borrow from until your ARs come in. Pay off your line, put the rest in the bank, and that when that time comes,
that might be a future webinar, though. It's a bit technical, I know, for some people, but it's the whole art, and it is an art, the whole art of working capital management.
Absolutely.
But use, we've talked maybe we need a separate webinar on lines of credit, but yeah, they're an excellent tool when well used, and certainly better than a credit card. All right, we'll stop here, everybody. I've got 12:50 on my clock. Thank you again for joining us. Thank you again for the questions. Reach out to us as needed. I'll share some information from Dan and Hector in your emails, and Hartford Matthews will connect you with them so they can put you in touch with somebody in Detroit. Hey, thanks again, everybody. I hope you have a wonderful week, and we'll be continuing these webinars through the summer. Thank you, everybody.
Thank
Ciao.
you, guys. Thank you all.
Have a good day. Thank you.
You got it. Bye.
Oh. Are you still there, Dan?
I am Hector. I got Emilio, you're still there?
It looks like he's still on. I don't know if we lost Andrew.
I think we did, huh?
Yeah.
Yeah, I put
Looks
Emilio
like, well, it's just me and you now.
in the room, buddy. So good.
Thought it